It was the best trade in my mind at the time. You could get buffered exposure, good upside caps, but rates were still very low. And so now we move off of that low rate environment. Early 2022, we start to see that rate lift off. People were now buying CDs again. They're buying money market funds. And so that space broadly is about 4 times the size of the buffered space.
An equity investment with upside comparable to about the average yearly return of the S&P 500 and 0% downside, or 100% downside protection more correctly. Is it too good to be true, or is it real? My guest today is Matt Kaufman, head of ETFs at Calamos Investments, and Calamos Asset Management, I should say. He's going to help us unpack one of their latest products, which is literally a no downside ETF. Going to find out how it works, who it's for, and you can decide whether it's right for you. So, Matt, thanks for joining us.
Hey, James, thanks for having me. Glad to be here.
All right. So I'm sure you've gotten a lot of questions along this same line. We had buffered ETFs come out in 2018, which is sort of like the light version of what you got now, which was you got a capped upside and like a chunk of your downside was protected. You took a little bit of loss, and if things really blew up, you take more loss, but that kind of like middle zone was protected. This takes it to a new level. You get literally 100% downside protection in an ETF with roughly after fees about 9.3% upside potential, something like that, if I'm correct. And your latest product is based on the S&P 500. Can you give like the 30-second overview of how this works?
Yeah, I'll give a 30-second overview, and then I think going into the background of why it works is important too. And there's some history, as to the rate environment and why we can deliver capital protection and equity upside exposure at the same time today. So the 30-second story is that we're delivering a series of exchange traded funds. So not just one ETF, but we are delivering a series of 12 that will deliver 100% protection and then the equity upside potential of a broad index like the S&P 500 we launched on May 1st, which will give you 1 year outcome period exposure, the upside of the S&P 500, like you said, to a cap. There's no free lunch here. And then the downside exposure, 100% principal protection over that outcome period. So we have the S&P 500 we did in May. We're launching the NASDAQ 100 version June 3rd. That's the first business day in June. And then we're on file for a Russell 2000 series for the beginning of July. And we'll keep repeating that cycle so that there's 12 opportunities to buy in toward the beginning to get that full 100% downside protection.
Amazing. That's really cool. And if somebody's watching this and skeptical and says, okay, what happens if Calamos blows up, right? There's no credit risk with these. These are done with options, right? I'm guessing you're buying an at the money put. You're probably selling an out of the money call, and you're buying an in the money call to give the protection. And I'm guessing you don't get the dividend. That's part of like the package, right?
That's right.
So
yeah, that's the right conclusion. We can walk through an example of that as well. So these are all built using flex options, which are very customized options, exchange listed options on broad markets like the S&P 500, NASDAQ 100, and again, Russell 2000. And so, to walk through a quick example, James, let's pretend like you have $100. So I'm giving you $100 and we're going to recreate this capital protection mechanism. So we'll take about 98 of your dollars and we're going to buy a deep in the money call, or what we call the participation layer. And so that will give you the upside exposure to the S&P 500 and all the downside exposure minus the dividends, because dividends don't flow through options. We'll explain that in a minute. They don't go away. You don't lose them. They just get shifted here. So that's your first layer. You spent $98. The next layer is your protection layer. And we're going to spend about $4 on that layer. So that's buying an at the money put. It's going to give you 100% protection over that 1 year outcome period. So we're going to set the expiration date at 1 year. So if you've been following along, we have spent $102, but I only gave you 100. And so you could say, busted my budget. This doesn't work. But what happens is the third layer is your upside participation layer. And we're going to sell part of your upside exposure to pay for the remainder of that protection. So we're going to sell enough of your upside exposure to collect $2 so that our full cost is going to equal that $100 that I gave you. So you add those three layers together, you've got participation, you've got protection, and you have upside exposure. And that 9.8% cap rate that you were speaking about earlier is just the out of the money strike price on that call option. And so we've sold off everything above 9.8. So you're getting all of the upside of the market to 9.8% on a gross basis. And that package all sits together inside of an ETF, which is liquid, tax efficient, and can be bought and sold every day.
And the trade part is totally self-contained, self-funding. A 69 basis point expense ratio. That's just for you guys. You don't dip into that to fund the trade. Is that correct?
That's absolutely right. So your outcome is going to be based off of the full 100% of the money that goes into the fund. And then we charge an expense ratio, on top of that, so that it's decreasing the fund value, every day by the, annualized amount of the expense ratio. That's a little different than maybe a structured product or other types of products where you might pay an upfront fee, and then your outcome is based off of maybe 98%, 97% of the value of your assets. Yeah. Here, all of your money gets put to work, and then there's simply a fee on top of the ETF, like every other ETF.
And you mentioned flex options. If somebody says, hey, this is interesting, maybe I'll just MacGyver something like this myself. Yeah. What's your response to that kind of guy?
Yeah, you can get close, but you can't quite get to the same outcome with the same precision, the same tax efficiency as we can as an institution, and using flex options to do it. We can dive into why that is as well. If you were to go into the listed markets, you may not be able to find the precise strike prices that you need in options chain, or the precise expiration dates. And so it's going to be difficult to get all of those to align. But then there's an even more important point here, which is if you're using equity listed options, those are all American style. And so if you're not familiar with options, American style means that those options can get called away. And so as you're holding those equity options, you could get one of the legs called away and your trade would break down and you'd have to exit. Yeah. Exactly. You have to exit your position. But then the other suggestion would be, well, you can use index options, because index options are European style, which means they cannot get called away. You have to hold them till expiration. But index options, when you're building a capital appreciation type product, has worse tax treatment. And so by using the flex marketplace, it allows us to essentially flip those things. We can toggle, we want the equity listed options, we want the equity option for tax efficiency, and we want European style. And so it allows us to put those two things together. We can select the exact strike prices we want. We can make them all expire on the same day. And so it creates a really clean, efficient model. You put that inside the ETF wrapper, and now we can deliver tax deferred exposure in an outcome-based strategy that delivers 100% protection over that outcome period.
This is a market microstructure question that may just reveal my ignorance about market microstructure, but you guys are doing this. Innovators is doing this. More people are going to be doing this soon, I would guess, one of these days. If it's taking off, it's a great idea. As that marketplace gets more liquid, A, is that going to help the fees? And B, could it ever be such that you could have some kind of a rolling system? Because right now it seems like one of the kind of the limitations is you only get the exact parameters if you buy on day one. If the price drifts up or down, I mean, you still basically get like the bulk of the protection, but that's going to vary based on how the price has moved compared to day one when the contracts were set in place. So I guess my question is, what happens as more liquidity inevitably, or hopefully inevitably, enters that options marketplace?
Yeah, I think we can unpack that by going through a little bit of history. I spent some time, about 10, 11 years in an actuarial consulting firm, and was at PowerShares before that, early days of smart beta ETFs and helping build that business, and had a blast doing that. As we were building risk managed funds at our actuarial consulting firm, we had a very large, significant business doing that. We noticed the insurance companies and banks in a really low rate environment, right around 2010 to 2022, really moving into this risk sharing model. They couldn't deliver good upside and give you capital protection at that time because rates were just too low to do it. And so they moved into this risk sharing model where we could give you 10% protection or 20% protection, and then you can get significant, more meaningful upside over the risk-free rate by not doing 100% protection, but by doing something less. And so that business line worked very well for insurance companies. Banks were selling buffered notes all through, the 2010s era. And so that became the intellectual property for buffer ETFs and the defined outcome ETF space as we know it, that launched in 2018. It was the best trade in my mind at the time. You could get buffered exposure, good upside caps, but rates were still very low. And so now we move off of that low rate environment, into early 2022. We start to see that rate lift off. And like, guess what? People were now buying CDs again. They're buying money market funds. They're buying fixed index annuities. They're buying capital protected notes again. And so that space, broadly is about 4 times the size of the buffered space. So, buffers are great products. They work very well, but that capital protected space can now be built inside of the ETF wrapper because rates give you the opportunity to do that. So that's the space that we really want to capture. It's a space that hasn't been captured by the ETF yet. And I think Calamos is really well positioned to do it. We've got a good head start as well. We launched our first CPSM May 1st, and we've raised over $100 million just in the first week or two here. So it's gone really well. But again, that gives you that full 100% protection over the outcome period. And I think the second half of your question was regarding, do you have to buy in at the beginning? So if you look relative to a buffered product, if the market is going down significantly, you may fall through that buffer zone. So it's more beneficial to get in toward the beginning. With a more protected product or a 100% protected product, in the interim, you're still going to have really significant protection. So even today, we're 17 days into our outcome period. The market's up 5%, and CPSM is up around 2%. And so if you bought that product today, you would have about 7.5% upside, and you'd still have about 98% protection. And so it's really significant protection. And so we see people buying in every day along that outcome period. And you can see where you're at, through our website. We've got a chart that will just tell you those 3 really important parameters. What's your upside? How much protection do you have? And how many days do you have to hold in order to get that? So we see a lot of volume coming in every day, which has been encouraging.
That's great. That's great. Your website is very clear. You're right. It does explain exactly what you got. And I'm guessing the first month or so is when you're going to see most of the inflows into this kind of a product. What happens after a year is up?
So at the end of the outcome period, the end of the year, all of the options will expire. So just continuing with our CPSM ETF, on April 30th, 2025, those options will expire. We'll enter into a new set of options. You'll get a new upside cap, a fresh 100% protection level, and a new 1-year outcome period. You don't have to do anything.
Oh, you just sit there. Okay.
Yeah, you just sit there. If you do nothing, your money will stay in the fund, and it will continue to grow and compound tax deferred. If you want to take your money off the table, if you've captured that 9.8%, you're happy with that, you could pull 9.8% of your money off of the table and treat that like income to you, and it would be taxed as long-term capital gains, if you've held longer than a year and a day. But again, that money will stay in the fund and grow tax deferred.
So, Matt, I recently gave an example at a speech I was giving. If you had a baby and you took $500 and put that in a baby's account,
okay,
if it grew at the historical rate of the S&P 500, at least, past does not equal the future per se, but, pretend it does. By the time that baby is 70, that $500 would have grown to almost $500,000. Would you put your baby's money in this type of ETF, or is it for a different type of investor? Maybe someone who's considering an annuity, someone who might otherwise buy some other type of structured credit or structured product. Like, who is kind of the prime customer, and how concentrated is that?
Yeah, I would say this is for the inverse of a baby. This would be for a retiree.
Yeah.
And so we could think of from a longevity perspective or like a time value of money perspective. The younger you are, obviously, the more risk you're able to take. And so from a perspective of who is actually using this, excuse me, who's actually using this, retirees face a significant amount of financial risks as they approach and are in retirement. There's some health risks as well, but for the financial risks, you have longevity risk, the risk of outliving your money. You have inflation risk, the risk of your money not being able to keep pace with inflation. And then you have market risk, the risk of large drawdowns in the market really hurting your portfolio value while you're withdrawing from it, which really puts you in a difficult position. to continue providing for yourself when you no longer work. So we see people using this CPSM and the other structured protection ETFs as an opportunity to outpace inflation over time. And that really allows them to withdraw from their portfolio confidently because they have that built-in protection, and then they can outpace inflation, getting upwards of 9% to the upside of the market. And then you go down, on the time spectrum, you go down to a shorter time horizon. If you're somebody who has like cash on the sidelines, you have cash for maybe it's a vacation or you're buying a house at some point, you could tie that money rather than putting it in a CD or a money market. You can look at the trade-off that you would have there, which, CDs, money markets, structured products, and even fixed index annuities, they have expiration dates. And at the end of that, you're going to pay ordinary income tax on that money. Mm-hmm. And your money's locked up during that period. So your opportunity, you take a risk-free rate of 5%, you pay ordinary income at the end. If you're in the highest tax bracket, that turns into 3.3%. And so you could trade in that 3.3% for the opportunity to earn 9.8 in the market in a very transparent and liquid way. So whenever you need that money back, you can pull it back in, take it off of the market, take it out of the product if you need to. But we see, so all that to said, short conclusion, we see people using this as cash alternative, de-risking equity exposure, and then for retirees being able to outpace inflation. We see that.
Makes sense. And if I'm your marketing guy, I might even add one more point. There's a UCLA study done years ago that showed that people feel the pain of a loss about 2 to 2.5 times more, viscerally, than the pleasure of an equivalently sized gain. So some people, not talking about demographic, but psychographic now, some people just are really loss averse. And that type of investor might find a little bit more comfort or ability to sleep at night in this kind of a product, and they're willing to pay those bips for that. It could be worth it for them too.
I think so. I think these are good tools for financial advisors to use with clients that feel that way. It helps avoid some of those behavioral pitfalls that we all see and have highlighted for several decades, but somehow people don't change very easily.
if at all. Right. So if someone is Googling about this, they'll see the Innovators also has some products. They have a 2-year one, came out last year. I'm just your candid opinion. If someone's looking at both, is there a way to look at yours? How is yours special? I mean, it's a few bits cheaper, I believe. What else would you say in response to that?
Yeah, from a price perspective, we're at 69 basis points, and I believe some of the others are a little higher than that. We really feel like the 1-year outcome period is the sweet spot for 100% protected products like this. If you buy it over a 2-year time period, sometimes you're sitting at that baseline or that starting point for quite a while before you start to lift off. Mm-hmm. So we really feel like that 1-year period gives people the opportunity to capture money at a decent pace, but also capture that over the outcome period and reset at a frequent time period. We also think people operate in 1-year cycles, and so it just is a natural flow for a lot of advisors and their clients.
Yeah, the earth and the sun set a lot of things in motion.
There you go.
So someone's watching this, Matt, and says, I like Matt Kaufman. He's able to bring $100 million into this ETF in a week, and he's got my vote too. I want to learn more about this. Where would you send that person to?
Yeah, and hopefully you're not just buying into me. Calamos is a phenomenal organization. We've got
you're head of ETFs, right?
Yeah, exactly. 45 years of history. We have phenomenal, options-based teams. We're one of the largest alts managers in the country. Mm-hmm. We can go to our website, calamos.com, go to the ETF tab, and you'll find everything right there.
Sounds great. We'll put that link up on the screen or in the show notes below. So Matt Kaufman, head of ETFs at Calamos, you've been generous with your time. Thank you so much for sharing with us today. And thanks to you guys, as always, for watching us at home.